Here is a sentence that should make no sense. Last week, jobs data in the United States came in softer than expected. Fewer people hired, a cooler economy. And on Friday in Mumbai, that news helped push the Nifty up to close at 24,268, with information technology stocks, the companies that earn their living from American clients, leading the gains. Weaker American economy, stronger Indian IT stocks. If markets simply tracked the economy, this would be backwards. But markets do not price the economy, they price something else entirely. And once you see what that is, half the confusing headlines in finance start making sense. Why should you care? Because this pattern, bad news rallies, good news sell-offs, is one of the most common sources of confusion for anyone following markets. If you read headlines expecting strong economies to mean rising stocks, you will be wrong-footed again and again, and you may conclude markets are irrational or rigged. They are neither. They are just pricing a different variable than the one in the headline. Learning which variable is the difference between reading the news and understanding it. Here is the chain link by link. American jobs data feeds directly into what the Federal Reserve does with interest rates. Soft jobs data means less inflation pressure, which raises the market's expected probability of rate cuts. Expected rates are the gravity of finance. Every stock, everywhere, is valued by discounting its future cash flows at a rate anchored to those expectations. When expected rates fall, the same future earnings become worth more today, and the longest duration assets, like technology stocks, gain the most. Lower U.S. rates also weaken the case for parking money in dollar assets, which historically supports flows toward emerging markets like India. One soft jobs number pulls every link in that chain at once. Now the quant wedge, the part most explanations skip. The market did not rally because a weak economy is good. It rallied because the news changed the expected path of interest rates relative to what was already priced in. Before the data, traders had assigned some probability to rate cuts. After the data, that probability jumped. Prices move on that jump, the surprise, the change in expectations, not on the level of the number itself. This is why an identical jobs report can produce a rally one month and a sell-off the next. What matters is the gap between the number and what was expected. It also explains the limit of the game. Bad news is only good news while the market believes the weakness is mild enough to bring rate cuts without crushing earnings. If the data deteriorates past that point, the regime flips. Bad news becomes simply bad. Same machine, two regimes, and the switch between them is where markets get violent. Friday's tape showed the machine working. The Nifty gained 0.38% to 24,268. The Sensex rose to around 77,764. And IT stocks led, lifted by easing U.S. rate expectations after the soft jobs print. Now comes the test of the other side of the machine. Earnings. TCS opens India's results season on July the 9th. With the street watching whether operating margins hold near 24%. Rate expectations set the multiple on earnings. The earnings themselves are announced on days like that one. Watch how the stock reacts not to the number, but to the number versus expectations. The same surprise machine, running on a different input. So the next time a headline says markets rallied on weak data, you will see the machine instead of a paradox. Prices tracking the expected path of interest rates, moving on surprises rather than levels, inside a regime where mild weakness still means cheaper money. And you will know the question that actually matters. Not is the news good or bad, but is it better or worse than what was already priced in, and which regime are we in? That is how professionals read a tape. What you do with that reading is your decision alone. Educational content, not financial advice.